So it's official. The Fed has made their decision to leave the Fed funds rate or interest rates unchanged in their first meeting of 2026. So here's what that means for Orlando's buyers and sellers. Welcome to Dre's Take. After cutting rates 3 times in 2025, the Fed finally met for their first meeting of 2026 and decided to maintain its current benchmark rate, stating that inflation is still a bit above target, but that the jobs market is not necessarily sending red flags that would warrant any further reductions for the time being. Now remember that the Fed funds rate is not the same as mortgage rates, but it is an influencer over broader markets that do weigh heavily into mortgage rates. For Orlando buyers or buyers in general, this brings predictability. Lenders aren't reacting to surprise policy shifts, and that can make planning a bit easier for buyers who are in the market. Stable rates keep buyer demand on par. Doesn't shift things wildly. Unfortunately, it doesn't mean we're going to bring a whole bunch of new buyers into the fold, but it does mean that demand isn't going to fall through the bottom again. So here's Dre's take. This Fed decision isn't about acceleration, it's about confidence. Stable policy leads to stable markets, and that's a win for Orlando's housing market. All in all, I think that pausing here is probably for the best, because in the coming months, Jerome Powell will be exiting the Fed, and any minute now, the president will announce who he plans to replace Jerome Powell with. And if all bets are accurate, then that new Fed chair is likely to be more dovish or more aggressive in rate cutting. This can have one of two effects. Either spook markets in terms of inflation, at which point they may seek shelter in bonds, which would drive down yields along with mortgage rates. On the other hand, if the market sees lower borrowing costs as a potential growth booster for companies, then they could double down in equities and pull some demand out of the bond market, which would in turn drive yields up and take mortgage rates along with it. Either way that cookie crumbles, that means more volatility when it comes to mortgage rates. So by doing nothing at today's meeting, they stabilize things for now. Waiting to make a buying decision in the future could be a gamble. Time will tell. But we do know that for now, or at least the next couple months, things should be stable enough for you to do some planning and actually execute on something with some surety. That's it for now. I wanted to drop in and, do my thing, give you my take. And until next week, that is Dre's Take. All right, y'all. Take care.